Can you hear me? I need a response, please. Thank you very much. So my name is Tage Kene-Okafor. I'm a tech reporter for TechCrunch, and with me I have amazing panelists, Madam Yemi Keri, Mr. Razaq, and Mr. Jude. Please, a round of applause for them. So today we'll be talking about collaboration, competition, and increasing the pie for everyone to participate. Over the last two sessions we've had with Adrian and GB, and also other sessions, we've heard about collaboration within the tech ecosystem. We've heard about competition, and also we've heard about the population of the Nigerian youth, and also Nigeria as a whole. And one thing we know amongst fintechs, when you look at a typical fintech pitch deck, you see the Nigerian target market, 200 million people, right? But we all know that, fintechs are not serving 200 million people. It's usually between 5 to 10 or 20 at best people. And we know that financial inclusion has also made significant progress over the last couple of years. So the topic for today will be about non-consumption, and that's essentially increasing the pie for, like our topic today, beyond competition, how to expand the pie for everyone. So, we can have more consumers participating in the economy. So we will go to our panelists and have each and every one of them talk about the idea of non-consumption. We can start with you.
Okay, good morning, ladies and gentlemen. So I think that from an investor standpoint, we see a lot of decks. And when you see those decks, people tell you about their TAM and their SAM and all of those beautiful things in terms of justifying their numbers. But what they don't tell you is that group of consumers that are not being addressed, that do not, are unable to or are unwilling to use or purchase any form of your product or service. And those are those that are referred to as non-consumers. And those non-consumers are unwilling and unable basically because of different barriers or factors, cost, affordability, complexity, infrastructure, and really those are those that are referred to as non-consumers.
Razaq, do you want to expatiate on how that affects non-consumption affects the consumer market, having being one of the CEOs of one of Nigeria's main fintechs?
Yeah, thank you. Thank you. I think I can pass this across with a bit of a story. I remember when we had the initial idea of starting out Cowrywise. We're still at the very early stage at that point. And to be honest, the future wasn't that clear, just like the case with any other entrepreneur. And I remember vividly I had a discussion with someone, a senior executive in one of the Nigerian banks, about what we're trying to do at that point. And the discussion centered around what was our target market, right? And we're so confident, and we told him we're democratizing retail wealth management. We're trying to make wealth management available for the retail man, the man on the street. And he mentioned something that stuck with me since then. That what wealth are you managing for these people? And to be honest, at that point, it created a doubt that if you're trying to build a wealth management platform, the primary consideration usually is there has to be a wealth to be managed in the first instance. And that means that you're focusing on the top 1%, the top 2%, those who actually have the wealth for you to manage. But what we didn't consider then, or what the executive wasn't considering then, was the non-consumer, those who are currently not having access to wealth management, primarily because of the nature of wealth management service at that point. And the reason was very simple. The model of management service as we know it in Nigeria and in other parts of the world is primarily get few people, high net worth individuals, super rich people, and manage their wealth for them. But bringing that down to the retail man on the street who probably has about $1,000 in net worth doesn't make sense to a fund manager, a portfolio manager to do. It won't worth their while. So the point is, for the non-consumers, their behaviors are different from the regular or core consumers of a particular product. And the model of servicing them has to be different as well. If we have a retail customer who is having access to wealth management service, it will be uneconomical to have a portfolio manager dedicated to that retail customer, for example, because it will make the unit economics working. So the point is, for the non-consumers, the primary objective is they need the service, but they do not have the capacity to afford the service. So there is lack of affordability, and sometimes there's also lack of access. So to service that non-consumer segment, the model of service has to be different. And it has to be cheap to the extent that you're bringing a good number of them on board while making sure that the marginal cost of serving them is extremely, extremely cheap. And that is what can make it economically viable to serve them. So in the Nigerian market, for example, for a good number of luxury products or products that are primarily made for the top 1%, there should be a version for the retail man. An average man on the street deserves to have insurance, just like the richest man in Nigeria, for example. The average man on the street deserves access to investment opportunity, just like the richest man in Nigeria. But the nature of investment will now be different, and how they get served will be different. And that is the crux between having the consumer segment in the Nigerian markets and the non-consumer segment. So the non-consumer segment is huge, but the critical thing is the way to serve them has to be different from the way the core segment of the market has been served.
Jude, do you want to add to that? From your point of view, how does non-consumption serve as an overlooked opportunity for businesses and startups to grow the customer base?
All right, thank you very much. I hope you can hear me. First, let me start by thanking Endeavor for inviting the Exchange to be part of this conference. Bolaji Balogun is a critical stakeholder in our capital market, and we're quite happy to be part of this event. But from what I have heard so far, it's really a time well spent, given that non-consumption is a big problem that the entire economy is grappling with. So if you look at businesses today, you probably say it's a monopoly of some sort. Even starting with the financial markets, if you think about the population, over 200 million people, but less than 60 million actually have BVN, so the rest are financially excluded from the markets. And so if you think about startups that are looking to engage, it becomes really very critical to even look at how they can innovate around the three critical areas. When you talk about sustaining innovation, or you're talking about innovating for efficiency, or even creating new markets. So we think that because of this non-consumption pattern that we see, it provides a huge opportunities for startups. So rather than just be focusing on trying to gain market share from an already existing space, it does make a lot of sense to consider creating new markets. At the Exchange, we are a platform provider, and part of the things that we have done, recognizing even the tech ecosystem, is to create a new market, a new opportunity for tech companies to be able to access the market away from the traditional companies' requirement, because we do recognize what is involved in creating an ecosystem for the tech space. So today we have a technology board that houses fintech companies and big tech companies, and the idea is to move them away from the traditional sectors so that they're able to create new markets, innovate, and expand already existing markets. So in a nutshell, I think that non-consumption offers huge opportunities for startups. So they just have to think about how to expand already established businesses. And I believe that with the right innovation, we should be able to get them to get more people involved in whatever sector they're looking to scale. Thank you.
All right, thanks for that. And one thing we've all mentioned here is increasing access and also barriers to affording the services, right? And over the years, we've seen examples of that with M-Pesa, right, with mobile money, and also, since we're talking about financial services here, recently, MoneyPoint, OPay copying the model, and agent banking, in Nigeria, right, also diversifying financial access. And now financial inclusion in Nigeria is about around 60%, right? It's a long way from where we were like 4 or 5 years ago. However, there is still, there's still a long way to go, right? So are there like practical examples for, fintechs and also like non-fintechs, right, to carry out, right, to include more people to access the services? So what I ask is, we've seen progress over the years, but is it enough? And okay, so M-Pesa, for instance, started with USSD and now moved to mobile apps, right? And we have mobile apps as the de facto products, right, for any services we want to launch. So are there ways, for instance, you can, with digital bank, with agency banking, for instance, you don't need a mobile app to access it, to access financial services, right? So are there other methods, right, where, innovation can be carried out without using the mobile app, for instance, or just maybe using the mobile apps, but also lowering the barrier to entry via cost? Do you want to take that, Razaq?
Yeah. So financial inclusion has been a topical issue, not just for the regulators, but also for the government and other stakeholders generally. How do we include more people into the financial ecosystem? And the objective is pretty simple. You can't create prosperity without making people have access to finance. Finance in all its various shapes, from lending to wealth management to payments. They are the cornerstone of prosperity generally. We've seen some growth in Nigeria with respect to having more people being included within the financial ecosystem. But objectively speaking, that growth hasn't been as strong as we had expected, or as the regulators will even want it to be. That said, I think there are so many other factors responsible for the slow growth. In addition to enabling regulatory environments, which ordinarily should foster the development of financial infrastructure, enabling environments to enable innovators build financial infrastructure that can bring more people into the financial ecosystem. There are other macroeconomic factors, right? So for example, within the Nigerian ecosystem today, I doubt any new innovation will ride on the development of branch network as the basis to enhance financial inclusion. But 20 years ago, that was a strategy. But today, the strategy is quite different. And the reason why the strategy is different today is because there has been development of certain infrastructure. Internet access is a lot higher now than it was 20 years ago. And today you have a lot more people making use of smartphones than they were 20 years ago. So the implication is that branch networks are being miniaturized into smartphones. So you can basically perform everything you can do within a branch of a bank or any financial institution on a smartphone. So, but as a financial market stakeholder, you can't buy smartphones for everyone, right? So there has to be some form of development, some form of economic empowerment that enable people have the required purchasing power to have access to this technology before you can actually serve them. So there is the policy drawbacks in terms of how quickly are we growing the economy to enable a lot more people have the purchasing power to have access to this technology that can enable innovators have access to these individuals so they can serve them better over time. You can't leapfrog that, and that is the reality. So the growth we've seen is on the back of the appreciable infrastructural successes that we've seen, from internet access to mobile telephony, but there's still a lot more that needs to be done in order for us to include a lot more people into the financial service ecosystem. I'll also speak on, say, for example, capital, right? If we're talking about lending or access to credit in this part of the world, we all know the data is there. Lending is underpenetrated, right? Credit is largely at very surface level. But the truth is capital cheap right now in order to enable significant number of people have access to credit? Of course, we've seen growth in the number of lenders, online lenders, advancing credit to the retail market, but at what cost? Is capital cheap today to enable the retail man have access to credit in order to increase their personal prosperity? How much are they paying in interest costs? Is it actually net positive to them, for example? But as a business owner, of course, if you have access to capital, there's also that opportunity cost. There is a capital cost that you have to bear. Does that mean when you have access to that capital because you want to be charitable or you want a lot more people to have access to credit, then you provide that credit to them at a very low interest rate? No, there is a risk element involved. So there is a lot involved in all of these dynamics, including the economic factors, the policies that can enable the leapfrog that we all need to enable a lot more people come into the financial ecosystem and to be included financially. But so far, we've recorded some successes, but I think we still have miles and miles to cover.
Thanks for that. Okay.
If I may add a little bit to that, I think there are certain elements that we need to deal with, right? And the practicality of it. So we were talking about financial inclusion, or you're talking about the non-consumers. And you have already mentioned the cost of acquisition, right? But when you have a group or a community of people that are really not aware about the value or the impact of what you are providing to them, then they're at a loss. Now, you've also talked about the painstaking in terms of putting capital in acquisition, right? But let me give a practical example. We're doing a lot of data gathering for a company for financial inclusion. And in gathering that data, in some areas, we found out that it was not only about them not understanding why we're collecting the data or the benefits of having access to finance. It was more so as their beliefs and what they understand, that why are you collecting my name? It had to take a combination of one of the most respected people in the community, as well as somebody that had reciprocity of knowledge, one of the eldest people in the village, for us to be able to collect simple data. Because when you ask the girl, 13, 14 years old, what is your first name? She says Mulika. And what is your surname? Who is your father? She says Baba Beji, right? And there you cannot capture Baba Beji, and she doesn't even know her age. And there you have to go to the community and ask for the person that knows the history of the people in the community. So it goes way beyond, and it's a very painstaking process that you have to pass through for you to be able to gather enough data and also be able to communicate the value of what you are bringing to them for you to pull them into taking on whatever you're giving to them as non-consumers. I just wanted to achieve that.
Thanks for adding to that. And I mean, from what you've said about, so boils down to education, right? And also government policies that can enhance people to tap into the economy, right? But piggyback of what you mentioned earlier, Razaq, about how like businesses are expected, right, to make non-consumers consumers, right? But how do you see that playing out when they have to think about profitability, right? And Jude, I think I'll throw this question to you. So like, as you know, running Nigerian Exchange Limited, how do you feel businesses should pursue the fact that, okay, they have to provide services, right, to non-consumers to be part of the consumer market, but also like targeting profitability for the investors and also for the business?
All right. So if we look at just from the perspective of the job to be done, so what is your objective? So why are people not using already established products? And how do you then get the people who are not in the system to come on board? Sometimes it may not just be access, right? Because financial inclusion and financial literacy, people may have access, they may have a bit of understanding, but they may not have the capability to participate. So it's very important to look at it even from a startup perspective, that and some of the companies, even the listed companies, are beginning to respond to the purchasing power. It's a very critical aspect. So innovation should really be around access, infrastructure, but more importantly, how do you support the community that are not users to be able to use the product? And that will be around innovation, around providing credits of some sort, scaling the business in such a way that the cost of production matches those sort of customers, so that there's profitability and sustained growth for the business. If you look at the financial markets, for instance, where you have a population of over 200 million people, and you think about the number of investors in our markets, before this current banking consolidation, because the data hasn't been collated yet, we have an average of about 4 million people. And if you think about the active number of retail investors in our market, and our exchange is one of the largest exchanges in Africa, we are less than 100,000 investors. So where are the rest? Don't they need financial compensation or investment of some sort? But they're probably doing crypto or betting. So in trying to get these people in, it becomes really clear that providing financial literacy is key, but more importantly, also showing in terms of products that they can find interesting. So at Exchange today, we're creating products that will meet the expectations, especially around people who are concerned about FX. So if you have FX concerns, the devaluation, so what kind of products are you going to buy? So we have NDRs, it's called Nigerian Depository Receipts. These are receipts in Naira, but the underlying assets are in dollars. So the fund manager buys an S&P 500 in dollars, receives seats, and they're in Naira, and so the investors can then buy the receipts in Naira. But because underlying assets is in dollars, so when there's a devaluation, it will help reflect on the value of the investment. So the point is, the startups and innovators will have to be thinking around what is the end goal for the customer, because that will help increase the number of participation. So it's not just about access, capability is there, but more importantly, creating products that resonate with the interest of the investing public or the consumers, so that you're able to bring in more into your space.
I wanted to, ask, what kind of innovations do you see being like, again, building products in the financial space, Razaq? What innovations? Because you just mentioned a good point, Jude, about, I think everyone has mentioned here, purchasing power. And for instance, the GDP per capita a decade ago was around 2,000 plus. Now it's 1,000 plus, right? That's almost 100%, or if I'm not mistaken, decrease. So how fast can innovation meet up to, a dwindling purchasing power of like the mass market, right? Because in as much as we're providing these services, it seems like we're still stuck in, like where we were 10 years ago, right? And to Jude's point, we need more companies to list on the markets, right? So people can also, buy their stocks and see the value that these companies are providing. So I think my question is, what kind of innovations do you see that can bridge the gap faster between the purchasing power of the market, right, and also just innovation in general?
Okay, yeah, thanks for that. I think you mentioned something which is quite critical about trying to innovate around what interests people. And one thing we've seen about the non-consumption segment of the Nigerian market, especially as it relates to the financial service space, is that we have the demographic advantage in the country. A lot of young people, a lot of people have mentioned that, average age 21, 22 years, or 19 years even, which is quite remarkable. And we've also seen certain behaviors exhibited by these demographic segments. A lot of them are very sociable. A lot of them like football, they like sports, they like music, right, pop culture. So there are specific attributes and behaviors that this segment of the population exhibit from time to time. And this is where the innovation comes in as entrepreneurs. Even though you want to encourage good money habits, for example, you want people to invest, you want people to save. But a lot of them are more interested in non-investing activities. So how do you embed investment and saving into those kind of behaviors? And that is the whole idea of innovating and meeting people where they are more comfortable. If a lot of people like football, how do you ensure that while they watch football, there is some sort of investment and saving activities going on there? Because you can't change certain things. We can't be against the trend. We can't stop people from watching football. We can't stop people from betting because they can easily bet. They can easily bet from their mobile phone. Even the banks enable it. I'm not saying it's a bad business, but it's a business. They enable you to send money from your bank account to the betting account. So whether that is a good financial behavior or not is a different discussion. But the most important thing is if you want to cultivate good investment behavior in people, there has to be a way you embed your innovation into the behavior that they find more comfortable. And I'll give an example of what we've done, for example, in Cowrywise to latch on that kind of innovation. So we have a product called Savings Go. Nigerians are very passionate about football. They love football. They watch EPL, they watch La Liga every weekend. It is very difficult for you to have a weekend in Nigeria without a debate in terms of EPL. And what we've done is to build a product that enables people save and invest anytime their favorite football team scores a goal. That is the way to encourage people to cultivate positive investment behavior. And I think we need to have a lot more of this in order to change the tide, to turn the tide from people cultivating behavior that are somewhat negative to them in the long run and turning the tide towards behaviors that are positive to them in the long run. So we need a lot more of those kind of innovations. People are passionate and you can't do anything about the passion. So all you have to do is to key into that passion to enable them get some positive things out of it.
Do you want to add to that, Madam Yemi? Are you seeing innovations coming in play from the startups Rising Tide is backing?
So for many startups to be able to, they have to sort of see how they can create markets for those that are not included in that are not able to access or unwilling to access their products or service. And doing that really is to go down to the nitty-gritty of the why. Why do we have this non-conform consumers, and what are the issues? You've talked about affordability. There is also the issue of infrastructure. There is knowledge awareness. There's beliefs and all of those things. And really to be able to create a market or to pull them into move them from non-consumer to consumer, the major elements is really understanding how you can make a somewhat expensive product or service to be affordable. how you can make something that is complex more simple for them, how you can make something more convenient, right? But, you know, I heard a saying last week that innovation is the next level of customer convenience. And what customers are really looking at for now is convenience. And so how do you create something that will pull those non-consumers into your own market demography? And that is really where the element of innovation comes from for all of the founders and startups.
All right, thanks for that. Jude, I want to ask, you know, being in the middle of the private and the public market, are you seeing some form of collaboration between, you know, corporations and startups, right, in addressing this non-consumption issue that we have in the country? Because I feel, you know, corporations have, you know, money to spend that startups don't, right? And I think that can go a long way in bringing non-consumers to the consumer market. Because when you look at it, you know, fintechs are going against banks, and for the most part of it, banks are, for lack of a better word, they don't really, you know, care about, you know, people that don't have money per se, but like, you know, startups do, and they go after them. So are you seeing some kind of collaboration between, you know, the two different kind of companies?
All right, thanks. So there's a lot of collaboration, and if you think about what startups really do is to magnify or focus attention that the big corporations may not have a desk for, because they will look at it purely from an expansionary business strategy. But in terms of the nitty-gritty, especially around ESG-related matters, then the startup can actually integrate from that perspective, because one, they will leverage on the structure already established. Earlier on, they talked about regulation. Regulation is very key when innovation is being talked about, because ultimately innovation will be ahead of regulation, but because the big institutions already have it embedded, so the startups can leverage on that. So what they will provide is really an offshoot of some sort to the established businesses to ensure that they're able to bring in more customers. And I think that's really the point. The big corporations will really focus on sustaining innovation that they already have. At best, they will try to do efficiency innovation around their operations and how they operate. But the startups really have the opportunity to leverage those corporations to create new markets. That's really where the task lies. And that is how I think they can collaborate. Once they are able to do that, leveraging on already established infrastructure of the big corporations, then the consumer, they are closer to the consumer, will then be able to utilize what products that they are providing or service that they are providing, because they are closer to the consumer. And I think that is where the collaboration really lies, the ability to have a focused attention on the customer, because the customer is constantly seeking for new experiences, new ways to get that job that they really want to be done. And as a startup, that should be the primary concern as to what is it that the customer really wants to be done, and getting it done for them in a very easy, affordable, but beyond that, satisfying manner. I mean, if you went to a bank today to get a loan, the whole process is very chaotic, right? But if you're going through an app provider that provides credit, and you can do that from the comfort of your home through your mobile phone, then it becomes easier for you to utilize credit. And I think that is what startups need to start focusing on, the ability to provide service products to the consumer at an affordable, fast, and easy to use approach.
You talked about regulation, and I think my next question will revolve around, you know, if you think there are frameworks that, I mean, maybe you can advise governmental agencies here, if they are, right, on policies they should enact, right, to make, to address the non-consumption issue that we have. And Jude mentioned banks having a place in creating sustainable and efficient markets, efficient innovation, right? While startups can create markets, right? And I don't know if you've read the thesis by Clayton Christensen and Efusa, right, about market creating innovation. And most of the key points that they made boil down to large corporations creating or manufacturing something that changed the whole nation. I don't think we've had such creations in this country. Could that also be the fact that we are not a producing or manufacturing company like the likes of maybe Japan, right, or China? These were emerging markets back in the 80s, same as we were, and now they are way ahead of us. So could policies also address the fact that maybe manufacturing can become easier to make manufacturing cheap or production cheap, right? So people can tap into that and provide cheaper services to non-consumers.
Yeah. So I will address two items there, riding on what Jude said earlier and then the regulation part. I think first and foremost, regulation can be a very strong enabler. It can unlock an entire industry. It can either unlock or kill an entire industry, right? And a key example of that is, say, the Nigerian pension industry. I think the successes recorded today are partly driven by the regulation that came up in 2005, 2006. And we've seen how that sector has changed dramatically. Of course, you don't want to imagine what that industry will look like today without the Pension Act of 2005 or 2006. So that's a case study of how regulation can unlock significant value for the entire ecosystem and for the entire country. Even at that, we still have a long way to go because we still have 10, 12 million people that are within the pension industry right now when we have about 60, 70 million active workforce. So we still have a long way to go. That said, in terms of how collaboration can also unlock significant value, and I'll give an example of how we started, for example, right? We started out to offer financial services, but of course we didn't have a license, which is typical of most companies. So we had to start by collaboration, by partnership. And we partnered with a licensed entity in Nigeria to offer investment products. And the understanding then was very simple. There is nothing you can do with managing mutual funds. Creating mutual fund is regular, right? Of course, you can talk about generating alpha, additional returns, but the structure of mutual fund is structure of mutual fund, whether in Nigeria or in the US or in Europe, is the same thing. The key problem is not the ability to create mutual fund or to manage mutual funds. The problem is, how do you get these mutual funds to the hands of millions of people? That is where the problem is. So the original focus for us was how to get to those millions of people rather than creating mutual funds. So to do that, we partnered with licensed fund managers. So today we have partnership with almost all the major asset managers in the country. And the primary objective of that was, let us leverage partnership, because the consumers we're trying to bring on board are quite different from the consumers that the existing fund managers are serving. So, and that is where the idea of bringing the non-consumers into the financial fold comes in. That's where collaboration can unlock value. We're targeting a different segment of customers. They are targeting a different set of customers, but they have the mutual funds. Why can't we collaborate by enabling those mutual funds to be available to millions of people that ordinarily won't have access to those mutual funds? And we've done a pretty good job at that. That way, we can collaborate. The fintech companies, the startups, and the existing matured established entities can collaborate by ensuring that compliance is taken good care of by the established entity, while the distribution and the products accessible to the retail man is taken care of by the product innovation or distribution innovation that the fintech or the entrepreneurs have, and they are pretty good at that. One other example I'll mention is, I think the DNAs are also somewhat different, to be honest. The DNAs of, say, a fintech company or a startup company and an established company. And you mentioned something which is quite critical, that for an established entity, the focus is largely, let us, steady the ship. You're already doing a fantastic job, just steady it. You give less room for disruptive ideas. So there was this experience I had recently of one of the Nigerian banks. So I decided to open an account. And I realized that to use the mobile app, I have to talk to a manager to use the mobile app, which means the manager needed to onboard me onto the mobile app. And to be honest, there was nothing wrong with that. The messaging there is just that that kind of model is not suitable for the mass markets. Because if you really want to onboard 1 million, 2 million, 3 million, 4 million customers, you wouldn't build a product that requires someone to onboard someone. So the product should be self-service. So all I'm saying basically is that the model for the established entities that want to serve just few hundred or couple of thousands of customers is actually different from the models of businesses that want to serve 1 million, 2 million, 3 million. And that is the difference that everyone needs to understand ab initio in order to build a successful model that is profitable.
Thanks for that, Razaq. Yemi, do you want to add to that? Do you want to add to what he said about policies that the government can enact to create access for non-consumers?
I think that, Jude has mentioned that, innovations is really ahead of regulations and the policies. And it's reoccurring, and it's very evident when you look at the cryptocurrency and also even the Nigerian Startup Act. One of the critical things that, one must understand in terms of policies is that make or break. And the regulators also have to work hand in hand with the ecosystem to make them understand the kind of value of the innovation of the business that they're trying to provide to the consumers. And without that understanding and level of understanding of the value, you would either kill the business or you will propel the business. And so that's collaboration is very critical in creating a very viable ecosystem.
All right, thanks for that. A round of applause for our panelists, please.
Are you finished?
So we're taking questions from the audience. If you have any question, you can just raise your hand.
A round of applause for our wonderful moderator as well, please. So we have time for 2 questions. Do I have questions in the audience? We have a gentleman over there. Can the ushers please go to him behind the lady in the pink? And please hand him a mic. Please kindly introduce yourself and keep your question short. Do we have another question in the audience? So we have just one question. To the gentleman behind the lady in the pink. Yep. Right there. Yes, right there. I can just give you my mic.
All right, thank you very much. Good day, everyone, and thank you very much for the insightful session. My name is Sheriff Alaraba, the founder and managing director of Shalarab Consulting. So I have 2 questions. So the first one is, how can smaller players in an industry collaborate with larger competitors without compromising their own growth or independence? Then the second question is, in industries driven by competition, what cultural or organizational shifts are necessary to embrace a mindset of expanding the pie rather than focusing solely on market share? Thank you.
Great questions. Who would like to answer? Okay, please go ahead.
Maybe I'll start with, I think for your first question, it's really a collaboration with complementary products, right? you have to look for other organizations that will complement you. So if you're doing something like a biometrics product or service, you look for a company that has the hardware that you can collaborate with in order to expand your footprint. I think that would not compromise your own product. Maybe you want to take the second question.
Okay. So you will compete. It is normal. Competition is normal. And I think every entrepreneur will have that expectation to compete. So it's normal. But you need to understand where to draw the line between extreme competition and allowing for collaboration. And there are two angles to that. The first is collaborating with your competitors, right? It happens. And in that case, you are creating value that probably your competitor is unable to create, while your competitor is also adding value to you that you can create. In that kind of scenario, it's pretty much simple and straightforward. But behind that, there has to be serious trust building process where you are being trusted and the competitor is also trusting you. But another framework to use in order to establish whether you need to collaborate or not is to consider if you will compete, if competing with your other market players will actually enable you build a stronger market, or you compete yourself out of the entire market. In that scenario, it is very simple for you to just collaborate so that the summation of, or the sum of the part in that case will be much greater than the whole. The last part is, if the collaboration opportunity is not with a competitor, for example, I think that scenario is pretty straightforward. Say, for example, you are operating within the financial service space and you have the opportunity to collaborate with a telco, right? In that case, you are making a decision to either distribute a product or for the telco to also distribute that product. You are not producing similar products. You are only enabling your product to be consumed by the consumers of the telcos, or you are enabling your own consumers to consume the product of the telcos. So collaboration is something that we need to have an open mind to, but also have it at the back of our mind that when it is time to compete, then you have to compete as needed.
All right, if I can speak to the first question, I'll just reference what Mr. Bolaji said around the 2 C's for startups. It's very critical. So if you have the competencies and you have the credibility. So the other element is being close to the customer. So if you look at it from the ESG principle, the environmental implication of that business, the social impact, and the governance structure. Those are the areas that I think as a startup you really need to focus on, because that's the value you will bring to the big establishments. And so it becomes easier because you have the competencies, they will listen to you, you have the credibility, then they will, we had it here, then they will give you a try. If you think about all the big names that we hear of today, it just took somebody to take a bet on them because of the competencies that they saw. So it's very important to really be on top of your game as a startup. You really have to demonstrate the understanding, really that understanding of the ESG, the environment, the governance structure, but more importantly, the impact, especially since you're trying to create new markets and want to bring in new consumers on board. Thank you.
Thank you very much. Let's put our hands together for this amazing panel. Our amazing moderator, Tage Kene-Okafor, Mr. Jude Chiemeka, Ms. Yemi Keri, and Mr. Razaq Ahmed. We will be taking pictures, so please, panelists, stay on stage.